Our next guest says, thank President Trump and his corporate tax cuts for this massive bull run. Let's bring in Nobel laureate, Yale professor Robert Shiller. Welcome back to the show, Professor.
My pleasure.
So what happens after the initial sort of absorption and processing of the tax cuts to the economy? Does it get tougher? Is that the best of it?
Well, tax cuts are one of many factors that affects markets, and so we're just starting to see the effects of the tax cuts. But I think it's affected the psychology of the markets. People are not mostly calculating what the corporate profits tax will be. They're thinking Donald Trump is president. It's a new era. He's an inspirational speaker. He's the first U.S. president who has a history as a motivational speaker. So I think this market rally is a complex interaction of psychology and free market economics.
So how would you assess this bull run, Professor? I mean, all day long on CNBC, we've been saying, you know, what brings this to an end, if you will, and how much longer has it to go? What's your view?
Yeah, so now I think that that we've set a record on length of bull markets. That has to be, for most investors, a worrisome sign, because we've had 13 bull markets, I think, since around 1930, and this is the longest one, well, by a day, apparently. So the question in my mind is, how much are people paying attention to this? All over the news. The last time we had a bull market record set was in the 1990s, and it didn't correct the market for years after. People started talking about the longest bull run in around 1996, and it went for 4 more years going up. So my suspicion is that this news is not so dramatic, and it's not going to change the probability of a correction by a whole lot. But I could be wrong about that.
But you think I mean, it sounds like you think the market will still go high, that there could be many more years of gains for this market before this bull run ends.
Yeah, so it was around 1996 that people started to worry about the longest bull market being a negative indicator. But it didn't, the CAPE ratio, which I like to use, cyclically adjusted price earnings ratio, rose to a much higher level than it is now by 2000. It was almost 50% higher than it is now. So it's, I just don't think that these kinds of ratios are determinative in most people's thinking. You know, they make news when they happen, but in the history of the stock market, they haven't predicted turning points.
In terms of the market's technicals, Professor, I mean, it's interesting because we had an article in the Wall Street Journal about buybacks. They're going to reach a record by the end of this year in terms of the amount of money being plowed into corporate buybacks. The number of publicly traded stocks has actually gone down dramatically. We're showing the numbers since 1998. So does that create a different dynamic where there's just the same or more amount of money chasing fewer shares?
Yeah, if we compare this with the long history of stock market, we are still in a moderate inflation period. So it's both inflation and stock buybacks that push stock prices up, even if there's no real gain in the strength of the companies. They're numerical things. So that's part of what makes this latest news about the longest bull market less impressive.